Hey, what's up, money mavens and freedom chasers? Welcome back to the channel. We've all got that dream, right? Financial freedom, the kind where you can kick back, retire whenever you want, and have your investments cover every monthly expense without ever dipping into your principal. Imagine waking up knowing your bills, groceries, even that spontaneous weekend getaway are all paid for by passive income rolling in like clockwork. Sounds amazing, doesn't it? But here's the big question. Can you kickstart that dream with just $10,000? Short answer, yes, absolutely. But here's the catch. You've got to know exactly what you're investing in and how to make it work for you. Not every strategy or investment will get you there, and that's where ETFs, exchange-traded funds, come in as the easiest, most accessible way to build that income stream. The problem? Not every ETF is cut out for the job. If your goal is to live comfortably in retirement, let's say with $5,500 a month in dividend income, you need the cream of the crop, the best dividend-focused ETFs out there. In today's video, I'm breaking it all down for you and our buddy John. First, I'll show you how long it'd take with a basic S&P 500 ETF to hit that $5,500 monthly goal. Spoiler, it's a slog. Then, I'll unveil a powerhouse portfolio of 3 top-tier dividend ETFs that can slash that timeline in half, getting you to the same target way faster. Stick around to the end. I'm revealing how this trio turns $10,000 into over $500,000, pumping out $5,500 plus monthly. Let's dive in. Let's start with the basics. Why ETFs? If you're new to investing, don't worry. I'm keeping it simple. An ETF is like a big basket of stocks you can buy all at once. Instead of picking individual companies, like betting on Apple or hoping Tesla's next move pays off, you're grabbing a slice of dozens, sometimes hundreds, of stocks in one go. They trade on exchanges like regular stocks, so you can buy or sell anytime the market's open. The magic? Diversification. Your $10,000 isn't riding on one company's roller coaster. It's spread across a bunch, smoothing out the bumps. Now, if you're thinking about financial freedom, the S&P 500 ETF might pop into your head first. It's the gold standard, right? Tracks the 500 biggest, most stable US companies. Think Microsoft, Amazon, Walmart, names you know and trust. These ETFs, like SPY or VOO, are rock solid for growing your money over time. Historically, they've averaged around 10% annual share price appreciation. Pretty sweet for building wealth. But here's the kicker. When it comes to dividends, the cash you need to live off, they're not exactly champs. You might be thinking, wait a sec, these are massive companies. Don't they pay big dividends? Not quite. Most S&P 500 ETFs hover around a 2% dividend yield, with a 6% growth rate. That's decent, but it's peanuts compared to what we need for $5,500 a month. So what does that mean for our $10,000? Let's crunch some numbers. With a 2% yield, your first-year dividend from an S&P 500 ETF like VOO is $200, $16.67 a month. Not exactly retirement material, right? Fast forward 10 years, with 10% growth and 6% dividend increases, you're at $650 yearly, $1.54 monthly. After 20 years, $1,750 yearly, $1.46 monthly. Even at 30 years, you're only pulling $3,800 annually, $316 a month. To hit $5,500 monthly or $66,000 yearly, you'd need a portfolio worth $3.3 million at that 2% yield. Starting at $10,000, with 10% growth and reinvested dividends, that takes, brace yourself, 56 years. You'd be 80-something before sipping cocktails on that dividend-funded beach. Why so long? S&P 500 companies prioritize growth, reinvesting profits into expansion, not showering shareholders with cash. Take Apple. It's got a 0.5% yield. Amazon? 0 dividends. It's all about reinvestment. Great for long-term wealth, lousy for income anytime soon. Now let's flip the script. If $5,500 monthly is the goal, we need ETFs built for dividends, ones that pay well now and grow those payouts over time. Picking the right ones isn't guesswork, it's science. First, dividend yield. how much cash you get per dollar invested. Higher's better, but it's got to be sustainable. Yields over 10% can signal trouble, like a company overextending itself. Aim for 3-5%, juicy yet safe. Next, dividend growth rate. How fast those payouts climb yearly. A 10% plus growth rate means your income doubles every 7 to 8 years. Huge for long-term goals. Then, payout ratio. What chunk of earnings goes to dividends? Below 60% is ideal, leaves room for growth and resilience. Finally, sector diversification. Spread across industries like healthcare, finance, and energy to dodge risk if one tanks. These factors, yield, growth, sustainability, variety, are the blueprint for a portfolio that delivers reliable, rising income, not just the flashiest yields. And based on this, I've handpicked 3 ETFs that crush it for our $5,500 mission: SCHD, DGRO, and EUFN. Let's unpack each one. First up, Schwab US Dividend Equity ETF, ticker SCHD. This is a dividend rockstar, perfect if you want stability with serious income potential. SCHD's been a steady Eddie, not chasing crazy highs, but delivering consistent returns for long-haul investors. Over the past year, it notched a 7.94% return, solid, close to S&P 500 territory. But its real flex is dividends. With a 3.5% yield, it's already outpacing VOO's 2%. But the magic's in its growth, an 11.04% 10-year dividend growth rate, and its hiked payouts for 13 straight years. That's reliability you can bank on. SCHD targets U.S. companies with a strong dividend history. Think blue-chip names that weather storms. Top holdings? AbbVie at 5%, Pharma Giant with a fat yield. Amgen at 4.79%, Biotech Royalty. Coca-Cola at 4.67%, the Soda King that's paid dividends since forever. These aren't risky flyers, they're proven cash cows. SCHD sector spread is gold. 18.54% healthcare, 16.53% financials, 15.4% consumer defensive, 11.54% energy, balanced, not leaning too hard on one industry. Plus, its expense ratio's a measly 0.06%, $6 yearly on $10,000, leaving more cash in your pocket. Annual share price growth? 7.71%. It's not a moonshot, but pair that with growing dividends, and it's a compounding machine. Risks? It's tied to the U.S. economy. If it dips, SCHD feels it. But its focus on quality dampens the wild swings. Next, iShares Core Dividend Growth ETF, ticker DGRO. This one's a growth and income hybrid, zeroing in on companies that keep boosting dividends. Its standout? An 18.31% 10-year dividend growth rate. Insane. Your payouts could triple in a decade. It starts with a 2.22% yield, lower than SCHD, but that rocket-fast growth makes up for it. First year on $10,000, $222, $18.50 monthly. But watch it climb. 10 years, $750 yearly, $62 monthly. 20 years, $2,600, $217 monthly. DGRO's share price grows at 8.73% annually, and over 10 years, it's up 129.56%. Proof it's not just about income. Sector-wise, it's tech-heavier than SCHD, 18.25%, with financials at 19.3% and healthcare at 18.5%. Top holdings? Johnson & Johnson at 3.33%, Healthcare Titan, AbbVie at 3.3%, Apple at 2.85%, tech with a small yield. Payout ratios around 50%, sustainable, leaving room for growth. Risks? Tech exposure adds volatility, but its broad base keeps it steady. Expense ratio? 0.08%, cheap and cheerful. Last up, iShares MSCI Europe Financials ETF, ticker EUFN. Unlike SCHD and DGRO's U.S. focus, EUFN dives into Europe's financial sector, banks, insurers, big players across the pond. Why Europe? Global diversification. Don't put all your eggs in one U.S. basket. EUFN's yield shines at 4.44%, $444 yearly on $10,000. Highest of the trio. Dividend growth? 5.41%. Slower than SCHD or DGRO, but steady. Share price growth? 2.33%. Not a sprinter, more a marathoner. It's 97.2% financials. HSBC, Allianz, UBS in the top 10, making up 41.06%. So it's laser-focused, adding variety to a US-heavy portfolio. Risks? Currency swings, European economic hiccups. Think Brexit or debt crises. But its 0.48% expense ratios reasonable for international exposure. And those banks have a history of solid payouts. Now the portfolio. SCHD, 3.5% yield, 11.04% growth, 7.71% appreciation. DGRO, 2.22% yield, 18.31% growth, 8.73% appreciation. UFN, 4.44% yield, 5.41% growth, 2.33% appreciation. Average yield, 3.5 plus 2.22 plus 4.44. Divided by 3 equals 3.39%. Average growth, 11.04 plus 18.31 plus 5.41. Divided by 3 equals 11.59%. Average appreciation, 7.71 plus 8.73 plus 2.33. Divided by 3 equals 6.26%. With $10,000 split evenly, $3, $333 each. Year 1's $11,964, $339 dividends, $625 growth. Year 10, $27,302, $920 dividends, $17,302 growth. Year 20, $97,189, $3, $300 dividends, $86,889 growth. Year 30, $529,500, $19, $324 dividends, $1,610 monthly, $510,176 growth. Total value added, $519,500, $181, $200 from dividends, $338,300 from appreciation. To hit $5,500 monthly, $66,000 yearly, you need $1.95 million at 3.39%, 36 years. S&P 500, 56 years. This trio has the weight, thanks to higher yields and growth. So $10,000 can spark financial freedom, but S&P 500 ETFs take forever. SCHD, DGRO, and EUFN get you there faster. Want $6,000 monthly from $20 weekly? Click the video on screen. Love this? Smash that like, drop your thoughts, and let's build that dream together.